Well, hi, this is David Friedman, one of your co-hosts for TCA Crossroads, where entrepreneurs and investors connect. And I'm with my co-host, Dave Berkus. How are you, Dave?
Hey, that's me. And it's springtime and the flowers are in bloom, and I'm a happy camper. So let's
And you
get
don't
going.
have hay fever, so you're not going to sneeze it up, right?
That's correct. I'll do my best.
Yeah. Well, hey, this has been an exciting, month so far. We have OC Innovation Week. We had some meetings over at Chapman. It seems like spring has sprung and entrepreneurs are popping out all over. I've seen maybe about 40 pitches in the last couple of weeks. We have our conferences coming up down the line. I am so excited. I don't know how you feel and what you're seeing. What are you seeing in the markets today?
In the markets, well, obviously we've had some fluctuations, and we can talk about tariffs when we bring our guests on. That's an important one. And I've seen that rattle some of my companies. And so we'll have that conversation.
Yeah, and this is going to be exciting. I'm going to bring them on right now. And there they are. Hi, Cecily, and hi, Dave. How are you?
Good to see you.
All right, we're going to talk about a really exciting subject today, investing in uncertain times, assuming that you believe that these times are uncertain in the economy. So you can do a quick introduction, Cecily, and then Dave, and then I'm going to turn it over to Dr. Berkus for the first question for 40 points. So Cecily.
Hi, Cecily Mack. I'm one of the co-founding general partners of Wisdom Ventures. We just finished deploying out of our first fund. It was our minimum viable $10 million fund. And we're actively working on growing our second fund. We had our first close last week. So good momentum. And I come to this work after 20 years, primarily working in mid and late stage startups as general counsel, chief revenue officer, COO, primarily in Silicon Valley and related companies. Great to be here.
Yeah.
Great to have you. And Dave, the
Hi,
Chapel.
everyone. I'm Dave Csepel. I'm the current chairman of TCA Venture Group. I'm also just starting a new position with SoCal Alliance as executive director there. So I think with the four of us, we have a pretty good vision of the angel and seed market that we see in front of us, and happy to get to it.
Welcome on board. Dave, I'm going to turn it over to Dr. Berkus. We get too many Daves here. But Dave, I'm going to turn it over to you for the first question for 40 points. You can do a toss-up if you so desire.
For 40 points. Yes, let's play that game. Well, everybody, this is a strange time with the tariffs and with all of the instability going on around the world. And so we really have a question for both the investors, and we can speak for our entrepreneurs too, because I think probably all of us are coaching various entrepreneurs right now. And so the question is, are we in a time now that we should expect, at least for the next 2, if not 4 years, to just accustom ourselves to? And if so, do we change the way in which we coach our entrepreneurs to work? Cecily first.
Sure. I'm learning to believe that nothing lasts for very long. My main jam these days is impermanence of any expectation market-wise, founder focus-wise, LP appetite-wise. We've seen such dramatic shifts even just in the last 18 months that I think it's super important to just stay as nimble and as prepared as possible for what we cannot expect. As far as how that translates to how we're coaching or advising our portfolio founders, frankly, if they are building companies responsibly with the passion that helped us choose them in the first place, they're being both aggressive and conservative. They are being thoughtful about making smart bets. They're being intentional about priority hires. They are being thoughtful about having enough capital to sustain sufficient runway to get through difficult times. And so those markers of maturity and capacity and capability don't seem to shift very much despite fluctuating market conditions. And so our council actually has stayed relatively stable throughout this time.
Good. Thinking of the Sequoia letter in 2008 and how we all were affected by that, those of us who were around then, compared to the way in which we advise today, what I just heard from you is hold the course.
Yeah. I mean, I think we all have some scar tissue from 2008 and other dips and trials and tribulations, but I think that that's helped founders become more clear-eyed about how to weather periods of difficulty and how to be best prepared. And we look at it. I mean, any good investor is going to be asking their founders on a regular basis what their runway looks like, how's their burn. You know, it's always comforting to see and hear, 12 to 18 months, maybe a little bit more. Any less than that is concerning. It's similarly concerning if they've got 36 months of runway and they're conservatively building. We want to see them sort of in that sweet spot in the middle where we know they're taking advantage of the opportunity. Obviously, there's a need and market for what they're building or they wouldn't be doing it. So we want to see them land in the right place of that lane.
That's a good answer. Let me continue just by asking Dave, same kind of question, but how does this relate to angel investments and the entrepreneurs that we see as well as those that we invest upon?
Well, I think the TCA investors are seeing presentations where the entrepreneurs' heads are a little bit still in the clouds, at least with their valuations and so forth. But with that said, there are some good ideas out there, and I think to be scared away by this high interest rate and tariff uncertainty environment would be a mistake. As Cecily made a good point, it's, we too at TCA think that, and there's a lot of good ideas and there's a lot of opportunities out there. And this is the time to pay attention to those companies where we can help scale them up at a certain point. Somebody once said, you don't skate to where the puck is, you skate to where the puck is being passed to. And I think all of us are looking towards, after, hopefully the tariff scare goes down and supply chains get worked out, hopefully in within a half a year, there's going to be a whole new economy. And, these companies are smart to work very, very hard behind the scenes and then be ready for when the economy eases up a little bit and hopefully interest rates go down. And so investors like ourselves will feel more ease about taking money out of our margin accounts or just spending money on some good opportunities.
Appreciate your optimism. Turning it over to Dave.
Yeah. So are you finding the economy on a scale of 1 to 10, 10 being fraught with so much difficulty, you're having trouble finding investors, no one's investing? Or are you finding it sort of like cautious optimism in recruiting people for your fund, Cecily, or for TCA Venture Group, Dave? So I'll turn it over to Cecily first and then go into Dave. So how do you see yourself gaining new LPs?
Yeah. For us, it's been an interesting combination of predictable struggle and some wonderfully surprising, victories or wins in our LP pursuit efforts. I think generally, because there has not been a ton of liquidity for LPs, particularly over the last 4 or 5 years, there's a general air of conservatism, which makes perfect sense. If you're heavily leveraged and bet into venture and you haven't seen returns, it's hard to continue to double down and make additional bets into venture. You want to be diversifying where you're putting your capital, your resources. That said, because we have a very specific mission, we focus on tech-enabled well-being, we come upon LPs who deeply grok what we're doing and why. They recognize the opportunity in the market right now. And those calls, those meetings are shorter, full of life, and with, answers, follow-ups, and details on completing the process. So it's really more for us about finding the people who resonate with what we're doing and are ready to make a move despite the overall chilliness. And being patient and consistently communicative with those who are saying, will you please come back to us in a quarter or two? We genuinely appreciate and love what you're doing, but we need things to rebalance a little bit before we can make a move.
Got it. And Dave, when you look at TCA and its networks, are you seeing any difference across the entire group or within the network in either recruiting members, recruiting people for the fund? Any things that you hear from our membership?
The one thing that's on the up is we are having success recruiting members. I think a lot of folks from the outside realize this is a good time to kind of take a look behind the curtain and see all the good things that some of these entrepreneurs are working on. However, as we all know, and we pointed out, there haven't been a lot of decent exits lately, and so it is hard to get that mindset to say, all right, let's put back in when you haven't really cashed out. Nothing has become liquid in a little bit. So that's the environment we're in, but that doesn't mean that there are not some good companies brewing out there to be launched.
Which leads me to the question about expectations. And we're speaking now about LPs and angel members, respectively. And so the expectations may have changed. The average years to liquidity for an early stage, David, has been extended. And mine is 11. And so I think it's the ACA that quotes as 7 for a positive exit. And so Cecily, I'm sorry, how does that relate to a later stage or a larger fund in the expectations of your limited partners?
When we look at our fund one as a track record and we assess that portfolio of examples, we've actually seen accelerated growth across that 38 companies, that set of 38 companies. We've doubled the fund value in under 3 years. So we're kind of out of the typical range returns wise, at least on paper. And we attribute that in part to the intense level of interest in the fields that we're investing in, which are this kind of, again, I'm going to say tech-enabled well-being, but that also includes AI, things around mental health, tooling to support physical well-being, employee well-being, femtech, and so on. And so we position ourselves as a little bit outside of the conventional model time-wise, and we anticipate that same trend for Fund 2. That does not mean that we're telling our LPs, get excited, you're going to be seeing returns in 4 years. We want them to be as patient as anybody else and aware of the cycles of this industry. And most of them are. I mean, this is what they do. They carefully select in a very few number of funds, most cases. So, but yeah, we haven't really had to shift our tone too much in spite of that.
Before getting to David, I really want to follow up on that.
Yeah.
When you price, are you pricing to market or are you pricing to the last event?
Sure. No, we're pricing to the most recent round raised.
That's the right thing to say. Just asking.
Of course.
David, take that same question to the angel environment and expectations.
Well, we are expecting those entrepreneurs to be real with us. A lot of the rounds that we're seeing, we're finding a lot of groups who are just starting their raise. And again, as I said before, we're finding a lot of folks kind of unrealistic on their raises. If it's something that we feel they can scale up and they've got, I don't know, 200,000-300,000 of revenue to be asking for a $10 million valuation when the IP is not so special. We're seeing a lot of that, and we have to kind of sit down with them and say, hey, we'd love to work with you, but we need you to be real about your valuation, especially in this market. I think all of us on this call have seen many instances where we do a raise and it kind of stagnates for a year, for 2 years, and they're back in the market for something pretty close to the same valuation as to what we initially got into, and that's not a great feeling for investors to see something stagnate like that. And you also have to count on the fact that that a company could be back. So we're definitely demanding a little value when they come to us in this stage, but we also want to make sure they have enough money to complete the runway to get to that next stage and not just not do a short raise.
Yeah, and I'd like to say I make my money going in. And so that is an important question. David?
Yeah, so I'll flip it to Dave first and then to Cecily. Are you seeing changes in your investment strategy? We were at the ACA summit and everyone was bemoaning the state of affairs in terms of exits. Exits have been a lot slower, as you pointed out. So the membership in an angel is a little different than an LP. Are you seeing the angels wanting shorter returns, i.e. going to later rounds where they may not look for that 10x. They may be looking for a 5x in 5 years and instead of a 10x in 10 years. What are you seeing, or what are the new members coming in or the old members saying?
I'll take it first and then turn it over to Cecily. We are seeing a lot of members. Listen, we know that folks want their home runs, and they're willing to take a few, companies that just go away for the chance to get that home run. But it's got to be special, and it's got to fit that. It's got to fit the mode of where they see it can take off. Software as a service that can explode, that can scale up with not as much expenditure. That's of interest at least to 2 out of 3 of our TCA groups. That seems to be a focus. Other groups are focused in on medical devices and life science companies, where that could be a big home run and see a sale to a company like Medtronic or a J&J if it's if it fits that mold. So yeah, our investors, they're patient. They are looking to hit that home run. Absolutely. I mean, they'll take the singles and the doubles, but they're really in it for the home runs.
Yeah. Okay. Fair point. Cecily, how's it going with the LPs? Are you seeing LPs wanting different things, or are you just offering what you're offering as in the past and just trying to find the right LP for your investment strategy today? I'm trying to see if there's a shift in investment strategy.
Yeah. I mean, I think, if one thing is worth noting, and we have some LPs very savvy who are interested in co-investment opportunities. We have, the top 3 investments in our portfolio are Function Health, OpenAI, and Anthropic, all of which have had notable increases in valuation markups in the last 18 months or so. And of course, we have interested LPs who want to know how they can participate in similar opportunities for Fund 2.
Sure.
So that's a topic of discussion. It's not something that we are offering up in our initial conversation process, but for a good match LP, we're very happy to explore that path. It makes perfect sense. One of the ways we sell Wisdom Ventures is that we have unprecedented access to a certain set of founders in this space. I think there's also some savviness in the secondary market. They're not necessarily LPs that we're pursuing at the moment, but there is a very rich and growing network of investors who are participating in opportunities through secondaries, given the lag in other liquidity, more conventional means of an M&A event or IPO. And I think that that's going to increasingly be strategic and a part of funds in their 2-3 journey. So we're seeing that conversation come up quite a bit too.
Dave, over to you.
So that leads to a big question about lead versus follow. And so, Cecily, I'll ask you first. You have a small fund, relatively speaking, and you said it perfectly about the minimum size $10 million fund. You were right about that. And you're raising a bigger one now. Yeah. Are you expecting, I know you had to follow on the first one, are you expecting to lead some deals?
So yeah, not only did we follow in Fund 1, we actually often positioned ourselves as last check-in. We would meet with founders, and if we felt very moved by what they're building and we wanted to invest, we say, go off and fill out your round, hold an allocation for us and our target amount. And in many cases they came back, and in many cases they didn't. It let us lean into the diligencing resources of other investors because we're such a small team with very little operating money among us, or time, frankly, because it was sort of a side hustle for the 6 of us for Fund 1. For Fund 2, we're absolutely positioning ourselves to lead. We're still focusing primarily on seed stage, although seed stage has grown notably in the last few years, particularly within this space that we're focused in. We'd like to be able to lead as the first institutional check-in the $2 to $5 million range. And we recognize that is a very different position than this last check-in mode. It will require a different approach, different relationships, different conversations, both with our co-investors and also founders. One thing that is important to note in response, we do this all the time in our LP pitches, is that we are not really a threat to other co-investors. We've invested alongside some of the most recognizable names in the Valley, Union Square, A16, Google, even beyond, Khosla. And we're not working at their level, fund size wise. And we actually really position ourselves as a partner to the founder along the difficult journey of building what they're building. And so our peer investors tend to like to have us in. And if anything, a Wisdom Ventures lead for a seed investment lets the founder maintain some neutrality in picking a major venture investor lane a little bit farther along the road. Because we're fairly neutral. We're like the Red Cross of investing in some ways. That's actually really helped us, the lack of sharp elbows.
That is a contrast between angel investing. So I'm back to you, Dave.
We talked early on about the tariff and the tariff uncertainty and the craziness that has, created this volatility. I also believe in the long-term view that everyone should take, because what's in a bad market now will be in good. Market as things cycle through. But are you seeing the tariff effect on some of the deals that you're seeing, or the indecisions of people wanting to spend money now? Are they waiting? Are they participating? It may affect the LP market, but it certainly affects maybe the angel market. So I'd like to get your perspective as the GP. And then Dave, I'd like to get your perspective as the head of the angel group.
Yeah.
Cecily?
I'd have to say for us, I have yet to speak with a founder in our portfolio or one hoping to be in our portfolio that feels like they're being in the moment impacted by tariffs. There's still a pretty major wait and see energy around all this. Now, that said, in my own networks and in some of my own kind of side angel investing work, I think it's very different. I spoke with a woman last week who has a dependency on India and China for physical goods that she sells as part of her startups. And she has received the emails in the last 5 weeks. Prices just went up 30% across the board. And she's trying to figure out how to, or even whether she should communicate to her bulk buyers that this is a significant change in pricing. And so at the moment, her path has been to just wait. Continue to sell things at the standard prices and hope that it shifts for the better.
Yeah.
But at our level and our size, it's not hit us quite yet.
Yeah, Dave, and how are these things affecting the psyche of the angel investor in general? Are they waiting, or are they just going to ride it out?
The companies that our groups invest in tend not to rely so much on physical components that they need to get from Asia or from elsewhere. I would say probably affects about 20-25% of our portfolio at TCA. And as you all said before, kind of waiting it out seems to be the strategy of choice until it does settle itself for those companies that rely on it. So it's perfectly understandable. But again, we tend to deal more with technology that's more homegrown.
Yeah.
And so some of the, so most of the companies, they're able to source materials and have been sourcing materials domestically. And so it's of concern of the overall economy, because obviously, all of us, we need customers, we need clients, we need to make sure our clients are in healthy financial positions to purchase our goods or to purchase our software subscriptions. But as far as the companies themselves and their supply chains, it doesn't affect a dominant portion of our angel investments.
Got it. Okay, Dave.
Okay, it's about time to close, and so I'm going to ask that usual big question: is what kind of advice would you give, Cecily, in your case, to the limited partners rather than the entrepreneurs, and Dave, to the entrepreneurs rather than the members of the angel group? So Cecily first.
I would actually, I do very little advising of LPs, frankly. We interact a lot with LPs, but I would actually offer up an approach or a mindset that I also share with founders and also other investors from a fund standpoint, which is my own twist on an 80-20 rule. I think that there are a lot of folks who are exceedingly wed to metrics and facts and data and making decisions, whether it's a build decision or an invest decision. And then there are those who are maybe exceedingly dependent upon their gut. How does it feel? Do I feel like I want to build this? Do I feel like I want to put money into this? And I just, time and time again, I'm legally trained, so I tend to be hyper analytical, although a creative spirit at heart. I found that 80% on the facts and the data is very helpful, but I really encourage guarding and protecting 20% for gut and heart. There's just going to be opportunities that feel right and certain. That you see a twinkle in a founder's eye, or you believe in something that is going to be built despite the very difficult obstacles ahead. And I just think we should reserve, 20% of our choices, or 20% of our capital, or 20% of our energy. I think we can afford to spend on those more kind of impulsive, heart-led decisions than just the pure metrics-driven ones.
Yeah.
Got it.
Dave?
Okay, Dave.
I would say my message to entrepreneurs is stay ambitious, stay inspired. Even if your product is not out in the marketplace yet, and it's not a great environment perhaps to bring it out just yet, really fine tune it, work with focus groups, really know your customer as best as possible. And so that when it is a time to launch, it is a time where interest rates come down and then deals are flowing a little bit more rapidly, you're really ready to go. Raise your money, but dole out responsibly. Save your dollars for a rainy day. You want to gain the trust of your investors and show them that you can really make their funds last for quite a long time until you're ready to really scale up. So stay inspired and just get to work. And again, always communicate with your investors. Let them know where you're at, and they'll respect you for that even more.
Well, you heard it first. And thank you, everybody. And I'm going to turn it over to David to do the job of turning us off.
Well, I hope everyone is turned on by the words of wisdom. Passion for the entrepreneur, realism to make sure that even in this uncertain times, you're realistic in your valuation. Work with the investors and the entrepreneurs are not at odds. They should work together. And ensure that you take a look at the long term, because these minor fluctuations that we're going through right now with the tariff uncertainty will stabilize. And I think it's a really good time to invest. But I really do appreciate Cecily and Dave spending some time with us. I think both the entrepreneur will get some very useful information out of this discussion in this panel. And I believe the investors hopefully will be encouraged that there is a light at the end of the tunnel. And as Dave said, as Wayne Gretzky said, actually, we skate to where the puck is going. And with that, I wish you all a great day. And thank you so much for participating.
Thank you. Good to see you all. Appreciate it.